Hello and welcome to another edition of Money Matters here on KC Radio 97.7 FM. Today I thought we'd quickly touch on rental properties, but most importantly on the tax deductions available for those of you that currently own properties or are thinking about investing in a property. Generally speaking, a landlord is assessable for any income that a tenant pays them on their rental property. And adversely or against that, they're also eligible to claim a tax deduction for any expense incurred on that rental property. Some of these may include, but not necessarily limited to, agents' fees. Might be some accountancy fees to do with it. The big ones being bank charges and interest charges from the banks or the financial institutions that may lend you the money. There's cleaning, gardening, repairs and maintenance, lease preparation costs, maybe some tax advice, travel to inspect the property, body corporate fees, power supplied to the property. We have our normal council rates and water rates, and the list can go on and on. Your job as a property investor is to keep all the receipts to do with that property. Our job as your accountant is to certainly tell you whether they're deductible and in what form. There are many expenses out there, and it's very important that as a property investor you understand this. Let's have a look closely at some of the bigger ones that may impact, or what certainly may add up over the years. The first one is interest. And interest, or the deductibility of interest, is quite simply determined by the use of the borrowed money rather than the security provided. So what you need to do, it's the purpose of the loan. So if the purpose of a loan that you've undertaken is to purchase that investment property, not the security put up, then you can claim that interest as a tax deduction against any assessable income amounts received from your tenant. That, along with bank charges, along with other fees that the banks may impose, should be included on your tax return as a tax deduction against that assessable income. Some of the other major ones, and the biggest one, is around repairs and maintenance. Initial repairs at the time of purchase cannot be claimed as a tax deduction. They basically form part of the cost base of the property. So if you are to buy a property that maybe is a bit run down, or that maybe you put it, before you put a tenant in there, you'd like to do a bit of work outside in the garden, maybe give it a fresh coat of paint, or touch up on the oven or the dishwasher inside the home, they are costs that you've incurred at the time of purchase, and as a result form part of the cost base of the property. However, during the time of renting the property, there are going to be expenses that you'll need to incur. So there may be a leaky toilet, there may be an air conditioner repair, maybe a tenant is not as clean as you'd like them to be, and when they vacate, you then undertake a fresh coat of paint around the house. All those types of expenses are as a result of tenant damage or tenant wear and tear. And as a result of that, those expenses can be claimed as a tax deduction against your assessable income. Depreciation is another big one, and there are two types of depreciation out there that we can use to claim against your assessable income. The first one is what I refer to as normal depreciation, and that's on all your fixtures and fittings. Examples of that would include maybe the dishwasher, curtains and blinds, light fittings, split system air conditioner, carpets. All those type of things have a limited life, and as a result of that we can claim depreciation or wear and tear over a number of years. The other major one, and the area where most people that I see or that come to us as new clients are simply not doing, and I do not understand why, is what we refer to as building write-off allowance. Quite simply, any property where the capital works commenced after the 17th of July 1985, we can claim 2.5% per annum, in some limited circumstances 4% per annum, of the construction costs to do with that property. Doesn't sound like much, but it's a tax deduction that you will receive against the assessable income when the money is not even coming out of your pocket. Don't know about you, but that sounds pretty great to me, and it's something that you should take advantage of. The other area is inspection costs. Not saying for a moment that you can just drive past your property every night on the way home and say that you've inspected it and claim the kilometres associated with it. However, you can certainly, if you need to go and undertake repairs, if you're the type of person that every 6 months likes to walk through the property and do a proper inspection, then certainly keep a logbook or a travel diary of those kilometres, and you can claim a tax deduction for it. In summary, rental property tax deductions are out there. Most importantly though, you need to keep all receipts and substantiate any claims. Again, your job as a landlord and as an owner of that property is to keep hold and to summarise all your documentation. Our job as your accountant is to tell you what we can do and by how much. Again, feel free to visit our website at zjl.com.au, and there are many fact sheets available on rental properties and certainly on the different types of tax deductions available out there to help you determine what you can rightly claim. Thank you again.